Peachtree Group recently launched a new Special Situations Fund. In this investor presentation excerpt, CEO Greg Friedman and EVP Michael Ritz discuss with Daniel Savage the mispriced opportunities they see in today's commercial real estate market. Let's dive in.
Good morning, and thank you for joining us today. My name is Daniel Savage, and I have the pleasure of being joined by Greg Friedman, Peachtree Group Managing Principal and CEO, and Michael Ritz, Executive Vice President of Investments. During today's presentation, we may make forward-looking statements and that this should not be considered an offering. Investment decisions must be made in full consideration of the fund's private placement memorandum. Greg, when you're considering the CRE investable universe, what really defines a special situation?
So it's really a situation where you're buying an asset that's in in most cases a stress, or in some cases a distress type scenario where it needs a unique structure in order to effectuate that investment opportunity. So it's going to be an opportunity where you're not buying just traditional equity, but you're coming in and buying an asset where you have to be more structured, where you're giving hope notes, or you're coming in as preferred equity, where you're going to be senior to the common equity, or you're buying through the debt. You're buying, a first mortgage loan, maybe a mezz loan secured by the real estate. You're going to be buying with the angle that you're going to end up owning the real estate, and it's a means to get into the real estate at a much more compelling attachment point. So those are, just high level how I would look at special situations.
Yeah. Michael, what are you seeing in terms of a market lens and what's really driving the opportunity?
Yeah, there are a few key target catalysts that we're keeping an eye on, and we're starting to see a lot of deal volume from, and a lot of it is driven by that heightened volatility within the capital markets. So it's not necessarily levels of distress from an asset fundamental perspective. Fundamentals generally across most commercial real estate assets outside of office are doing pretty well. But what we're seeing is just a heightened level of volatility for all the reasons that we'll get into more detail later. And because of that, there's really a few key buckets where we're seeing these potential opportunities. One is event-driven opportunities and solutions, which can be, anything from renovation needs, outsized capital calls, senior pay downs. So maybe a senior loan needs rebalancing as a solution to get additional term or better terms with a senior so that whoever does own that asset can continue to own that asset for a longer period of time. And as Greg said earlier, these are more creative solutions and not necessarily just main fairway solutions. They've got to be tailored to this specific cause. Distressed assets, which I think we'll see a lot of, and we're already seeing a lot of opportunities in this space. And that could be, foreclosures conducted by banks where they're selling us foreclosure judgments. There's deed in lieu opportunities where a bank has negotiated the transfer of keys from the borrower to the bank, but the bank doesn't necessarily want to own that asset. Partnership buyouts, just a whole host of reasons that can cause distress on a balance sheet where we can provide a solution and an investment opportunity to really get us an outsized potential upside. And all of these are something that we've done for a long time since our company's founding, but valuation creation opportunities is us purchasing assets, repositioning, rebranding if it's a hotel, direct to seller conversations with our unique originations pipeline, which we'll talk about here in a little bit, and conducting CapEx, heightened renovations.
Thank you. And then, Greg, just stepping back a bit, do you want to talk about Peachtree Group's ethos and greater DNA and, where we've been and where we are now?
Absolutely. So Peachtree, as a firm, we started the business back in 2007. Myself, as most people know, I have two other partners, Judd Desai, Mitchell Patel, but we originally started the business as a firm that was investing across commercial real estate. We, had a lot of investments, not only in commercial real estate, but also within rental assets. On the equity side, we, very quickly, experienced the great financial crisis. And the reason I mention that is quickly pivoted from being just a buyer or developer of assets to being, very heavily invested through credit into commercial real estate, all property types. Because we were buying debt secured by hotels, and subdivisions, small office, things like that. Financial crisis. And we continue to grow the platform. So as we sit here today, we've created an ecosystem that invests up and down the capital stack as it relates to commercial real estate. So we invest, very heavily through credit. We bought a lot of distress or stress credit over time. We do a lot of direct lending as well on the credit side. We buy a lot of loans from banks. So we have a really good capital markets team that has infrastructure across the financial community with regional banks, community banks, the national banks, and even other insurance companies and other lenders. As a firm, we're set up because we're vertically integrated. So we have different divisions set up to own real estate, operate, develop, and asset manage, and so forth. So as a firm, we've made well over 700 investments, since inception. We have a lot of depth, a lot of knowledge on within the commercial real estate space, again, both on the credit side as well as the equity side, and we even do stuff outside of real estate. And I just mention all this because at the end of the day, our ultimate business is that we're in the mispriced risk business. We're always looking for opportunities where there's mispriced risk. And as we're sitting here today, the biggest mispriced risk, hands down, within commercial real estate is within the credit side of the business, as well as within the special situation side. As a firm, we made a lot of investments. We've invested in well over $10 billion to real estate assets.
Michael, can you talk about what you're seeing now? What some of the catalysts and the drivers are that really allow for the opportunity for this strategy to be successful?
Right now, we see just a ton of potential value repricing. So a big movement in where assets are currently valued and where assets have been valued maybe for the last 3 to 7 years is really the overarching story to where we're finding and seeing a lot of the opportunities today. And a lot of that is driven by the debt markets. So it's where leverage has historically been across these assets, how it's been priced, the change from then to now. So as I'll get to here in more detail, we're seeing lower attachment points from banks and other traditional lenders at more expensive interest rates than they historically were, not because of the spread, but mainly because of that base rate. And I'll talk about that in a second. And then just a ton of value add opportunity because of that. So it's a lot of influx capital stacks that create unique challenges that you can't just go in and provide an equity or a debt solution. Sometimes it's a hybrid in between. And as Greg mentioned, we're just uniquely positioned. There's not a lot of competition in this space, ultimately because there aren't a lot of other sponsors that have both the equity side and the credit side of the business to be able to tailor that product somewhere in between in a hybrid model. So getting into a little bit more detail and talking about some of the macroeconomic factors that we see leading to a lot of opportunity and what we're already seeing today, we've got a very robust pipeline, mainly driven by these factors, is interest rates. So going back to COVID-19 and the cause of inflation that spurred out of COVID-19, the Fed in response to that increased the Fed funds rate, obviously putting upward pressure on the cost of debt, which therefore puts upward pressure on the cost of debt for real estate investment. And when we see increases in the cost of debt, we see a natural decline in the value of the asset, ultimately because the asset's fundamentals, as I said earlier, are relatively consistent. If debt costs more, there's less profit coming out of the asset, and therefore end buyers can ultimately pay less for it. This is the forward curve. This is where expectations of both the swaps and futures markets are expecting interest rates to go. SOFR is on here because SOFR is the typical base rate we use in the real estate market and widely used in other financial markets as well. But just for some context, SOFR was adopted as a replacement for LIBOR back in 2018. From 2018 to 2020, average SOFR was somewhere in the 2.5% range. From 2020 to 2022, until the Fed started hiking rates, SOFR was less than 10 basis points. And so what we're talking about is a whole host of assets that have traded on historically low interest rates. And then you see a forward curve here that just explains what the markets expect for forward curve or the forward cost of interest to be. So it's quite a substantial change, and we see that putting a lot of downward pressure on values. The reason we added the 10-year Treasury in here, just real quick, is that the 10-year Treasury is usually used as the risk-free rate when assessing risk premium spreads of various real estate assets against the cost of debt. And we see elevated outlook across a multitude of resources, whether you talk to the Fed, you talk to global research houses, brokerage houses, you name it, just heightened 10-year Treasury expectations for a whole host of reasons, putting a ton of pressure on that risk premium, which theoretically will start causing cap rates to rise. And that's where we're seeing a lot of our opportunity set in today's environment. And a lot of this, like I said earlier, is driven by debt. And so if you look at on the left-hand side, this chart is showing the percentage of total outstanding debt for that product type coming due in 2025 or short-term maturities. Hotels are outsized weighted. A lot of that was because of the short-term extensions that have occurred over the last few years, just as banks have been getting paid based on the good fundamentals of the hotels but they have not been able to completely recapitalize that debt. And so it's a lot of extend and pretend that's occurred in this space. So hotels have an outsized exposure to the near-term maturities, which is another reason we see so much opportunity in the space. Office being secondary, just a lot of secular headwinds. We're seeing credit opportunities that look pretty interesting in the office space. Some of the fundamentals and some of the risk profiles with the return profiles are starting to become pretty interesting and potentially bottom out in certain circumstances, certain street corners, certain neighborhoods, but something we're closely watching. And industrial, retail, multifamily, all relatively smaller from a percentage of total loan balance amount, but just something to keep in mind. Hospitality is the smallest product type on this chart, roughly 7% of commercial real estate in the US. So when you look at these percentages for multifamily or retail or office, for example, you're talking about, hundreds of billions of dollars in maturities, whereas, hotels are probably a couple $100 billion realistically. And we're actually seeing this cost of debt and the increase in interest rates play out on a real-time basis consistently. So on the right, this is a good chart that just outlines the average maturity or the average mortgage rate for a matured loan in 2024 versus the average mortgage rate for a new loan that was originated in 2024. And you're starting to see that couple 100 basis point spread that we were referring to earlier, putting that downward pressure on not only values, but really debt availability, which I'll talk to in a second here. And this is exactly where we're going with this is with an increase in interest rates, a lot of traditional lenders in their underwriting standards will be underwriting to a debt service coverage ratio. So they'll be looking at the real estate asset, what cash flow it's producing, what the ultimate cost of the debt service will be for the loan that they're originating, and how much extra or excess income there is. Given that they're underwriting on that standard and there's been an increase in the cost of debt, you've seen a really substantial downward trend in the loan to value, which just means that there's less debt availability out there. This is significant for a multitude of reasons. One of the primary reasons it's worth mentioning, and it's a really big piece of our strategy here, is because with less debt, there's a requirement for more equity to complete a capital stack. And there is already strain on a lot of smaller sponsors throughout the United States to raise that equity. But this drop off in debt and LTVs, which we see sustaining because of where the forward curves are and where expectations on interest rates are, means that there will be a heightened opportunity here in the near and medium term at least, and likely long term for these preferred equity solutions until we start seeing some serious value resets. Another key driver and catalyst is the heightened level of CapEx. So just to touch on the hotel space in particular, the hotel space has roughly $15 to $20 billion in deferred capital expenditures at this point. And a lot of that was PIPs and renovations that were pushed off when liquidity was tight back in 2020 and 2021, 2022. Brands were also giving forbearances on those renovations. They weren't requiring any of the franchisees to do those. That exacerbated by this slide, which is the outsized amount of supply that occurred in 2008. Typically, these assets are renovating on a 14-year cycle. If it occurred in 2008, we're talking about right around now. So you kind of have a confluence of different market factors in the history of this industry, not only with all the debt maturities and everything else that we were describing, but really heightened outsized need for capital expenditure liquidity, which is just not robust enough to cover the entire space by any means. And then just to kind of walk through how the cost of debt increasing and impacting cap rates due to the need for a risk premium, you have to have an incentive to take on risk of owning real estate. We walk you through an example where you have a $100 million asset and there's cap rate expansion. So your debt is more expensive, therefore you need more return on your cash flow. Just with that one change, going from an 8% cap rate to a 9% cap rate will take your assets value from 100 million to 89 million. So you've lost that amount of value, and that strength, obviously the owner's remaining equity in the asset. But what takes this a step further and why we have so much conviction in this strategy and we're seeing so many opportunities on a day in and day out basis is because not only are the asset values starting to move down and we're starting to see assets be remarked across all commercial real estate assets and every product type we're looking at. We also see debt coming in. So the debt availability, like I was describing earlier, lower LTVs, higher DSCR requirements, it creates a shortfall in liquidity within these capital stacks. And this is exactly what I was describing, where an owner may have $19 million in equity, can only get a $53 million mortgage because of the increased DSCR or the inverse, the lower loan to value that they're able to obtain, creating a $17 million gap in the capital stack.
Greg, would love the opportunity to hear some of past deals how you've sourced them, executed on them.
Yeah, definitely. So Hilton Garden Inn Tupelo is a great example. It's an asset we bought during the great financial crisis. You had a owner of the asset looking to sell the asset. We were able to come in and offer a very creative structure, reinvested or structured purchase where we were able to minimize any tax implications. You'd have a earnout piece that's associated or a hope note associated with the investment. This is a great example where very favorable pricing at a discount to market value at that point in time, as well as the intrinsic value. We ended up, selling the asset and generated, well over 8% return. So that worked really well, and it worked as we expected. The Hilton Garden Inn Casper is another example of a special situation investment. And what made this really a special situation was this was an asset that had historically done really well. Unfortunately, during COVID, the asset was foreclosed on and the lender had taken back the asset. We were able to come in and buy the asset through REO of the lender, as they owned the asset. It was a CMBS lender that owned it, and we were able to buy the property, at a deep discount. We had to, execute a very large renovation, and this was a very successful execution on our part where we were able to go in. We improved the operations overnight because before we took over, the lender had a third-party operator and it barely had, any cash flows at the property level. It was, effectively running break even. By the time we exited this investment, I believe we had close to $2 million of net operating income. So we, obviously generated huge cash flows for this asset relative to our basis. And we were able to, sell the asset and generated, incredible returns that were, around 20% plus. Next asset. And so this is another really good example of special situations. This is something we did towards the end of last year. It was an investment that we made that was because we didn't have the special situations fund available at the time. We only had our credit fund. It didn't fit the credit fund because this had a very high likelihood of foreclosure and the borrower was not making payments. We bought the loan at a substantial discount to its accrued and unpaid principal balance at that point in time. Effectively, this was an asset that was originally developed because these were two new assets that were originally developed for, I believe, over $40 million. So we were in a huge discount. So we were roughly about 40% of the original development costs. We were at a discount to the current values of these assets. And as we were moving towards foreclosure, the borrower was able to find a way to sell the assets before we could take the assets back. And so we were able to get paid off based on what was owed to us, as well as, we received most of our accrued interest. So this investment worked out where, again, we generated a really, really good outsized return that was well over 20% in this example, just given how quick it paid off. But that's, just another example where we bought it through a regional bank down in South Florida. And then the Marriott EC in downtown Atlanta was another example where we bought the asset in conjunction with a private equity group that had owned the asset. And we effectively bought it for around the debt balance at the time. They were in default, and we were able to come in and, this was an asset we, tracked for many years because it was a non-performing asset. It was a Holiday Inn in downtown Atlanta. So we felt like it was misbranded. It was a great location. We bought it at a really nice pricing because originally when we first started talking to this private equity group that owned it, they were trying to sell it for somewhere in the mid 30s, mid to upper 30s, because that was, their basis was closer, I think, to 40 million at that time. But we were able to come in and buy, this just shows our discipline in underwriting. We had our number we were willing to pay, and we executed on a large scale renovation to rebrand this asset to really capitalize on its location. And it worked very successfully. We sold this asset, we did the renovation, we sold it within the first, couple of years of, buying the asset and executing the renovation, and made well over 20% returns on this investment as well. The Days Inn in downtown Atlanta, it's another Atlanta project, is very similar. We bought the loan from a regional bank in the Southeast, and we bought it where this was something that was in trouble, because of the great financial crisis. We bought this asset, if I remember correctly, on timing, it was the end of 2010, it was the very beginning of 2011, but we had tracked it all over from 2009 till the first part of 2011. This goes back to why it's so important to have a pipeline because a lot of these opportunities we talked about, we chased for many years until pricing came to a level that made sense for us. But it's another example. We bought the loan at a huge discount, and we ended up, I believe we bought it for roughly about 12 million. We ended up getting paid off around 18 million because we ended up foreclosing, taking back the asset. For a period of time, we owned this asset for roughly about 6 months, and we generated a decent multiple on our invested capital, and it generated great returns that were well over 20% here as well too. We had as part of this acquisition, we knew we could go rebrand it. Ultimately, the buyer ended up rebranding it to an Aloft by Marriott. We already at the time was by Starwood. Effectively, we knew that was an option. That was originally our plan, but what we saw was the pricing that this buyer was willing to pay was most of the upside we saw on the rebrand side. So we just went ahead and said it was, from a risk adjusted perspective, it made more sense to sell than go ahead and execute on that rebrand option. And this is the Holiday Inn Daytona, another example of something we bought coming out of the great financial crisis. That was a special situations where it was a regional bank we bought the loan from. We got a substantial discount to it, when we bought the loan, and we ended up, foreclosing, taking back the real estate because the borrower wasn't making any payments, and ended up selling it and, making really, really good returns like the other ones we just talked about. And it just required us to have patience because we ended up owning it for several years. But as the market started to recover, we were able to sell it at a, huge gain relative to our basis. And it worked out to be a very successful investment for Peachtree and for our partner on that deal as well.
Thank you, Greg. How has the pipeline of current and expected REO changed since 2021?
It's definitely increased in 2021. Debt was widely available, and recapitalizations, refinances, asset values, just equity liquidity and debt liquidity in general were at all-time highs. So there was a ton of capital pumping through the system. The market was extremely efficient, and there was a lot less REO. If it was REO, it was likely a broken asset. So there was something fundamentally wrong with the real estate in itself. But today you see a lot more of good assets with tougher capital structures in play, and banks also losing the ability to have patience. From a regulatory perspective, banks had given a ton of patience at the request of the Fed, the FDIC, and the Basel Committee over years. And that has it's continued to a certain degree where they've allowed extensions, but banks need to recycle capital for liquidity, and a lot of them are trying to be more on the offense. We're already seeing those numbers come up, and the only way they can get on the offense is by creating outcomes. And the only way that they can create outcomes on assets that aren't paying off is to take the real estate and or sell the path to it.
Wonderful. I appreciate it. Both Greg and Michael, thank you for your time today.
Thanks for having us.
Thank you.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.